Today, we're stepping into the exciting and often unpredictable world of international business. Every time a company makes a sale or a purchase in a foreign currency, it's not just a transaction. It's a financial gamble. In this lecture, we'll explore how, as accountants, we measure and report the risks and rewards of these foreign exchange transactions. Before we dive into our case, let's establish the key language. The exchange rate is simply the price of another country's currency. The most important rate for us today is the spot rate, the price for immediate exchange. Think of it as the price right now. There is also a forward rate, which is a price for the future, but we'll save that for our discussion on hedging. Let's set the stage with a classic scenario. Our company, Eximco, which is based in the US, sells goods to a British customer. The price is agreed upon, 1 million British pounds. But here's the catch. Eximco gives the customer 30 days to pay. This creates a critical question for the accountant. The value of the British pound versus the US dollar can change every single day. How do we properly account for this risk? This is the core problem we need to solve. On the date of the sale, the 1st of December, the exchange rate is $1.3 per pound. That means our sale is worth 1.3 million US dollars on that day. But by the time we collect the cash 30 days later, the British pound has weakened. The exchange rate has fallen to $1.285. Our 1 million pounds is now only worth $1,285,000. The result? Our company has lost $15,000 in value, not because of a bad product or a bad sale, but simply because the currency exchange rate moved against us. To handle this, GAAP requires us to use the two-transaction perspective. This is a key concept. It means we must treat the deal as two separate and distinct economic events. First, there's the sale itself, the business operation of selling goods. The revenue from this is locked in on the date of the sale at the spot rate on that day. Second, there's the credit decision, the financial choice to grant credit in a foreign currency. This is effectively a financial gamble on the exchange rate. Any gains or losses from this gamble must be reported separately from our sales revenue. Now, let's add a common complication. What if the company's fiscal year ends before the customer pays? At the balance sheet date, our accounts receivable, which is an asset denominated in pounds, is no longer worth the $1.3 million we originally recorded. The rule is clear. We must revalue all foreign currency assets and liabilities to the current spot rate at the end of the period. We have to mark to market. The journal entry records the unrealized loss that has occurred so far. We debit foreign exchange loss for $15,000, which will hit our income statement, and we credit the accounts receivable to reduce its book value. Now, we fast forward to the day of collection. By the time the customer finally pays, the pound has weakened even further to an exchange rate of $1.272. This means we have an additional loss of $13,000 that occurred between our year-end and the payment date. So, on the day of collection, we actually make two entries. First, we record this final foreign exchange loss. Then, we record the receipt of cash, converted at today's spot rate, which clears the receivable off our books. So, let's look at the big picture and summarize the story this tells on the income statement. The sale element is locked in at $1,300,000 in sales revenue. The FX gamble resulted in two losses, a $15,000 loss in 2023 and another $13,000 loss in 2024, for a total FX loss of $28,000. The final net cash received was only $1,272,000. This separate disclosure tells a clear story to investors. we had a successful, high-value sale, but we took a significant loss on our foreign currency gamble.